Good afternoon, everybody. All right, I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Uh, my position disclosure is the same. Sizing changes, but the disclosure is the same. All right. So the market finished green today. The VIX finished red. That was something I really wanted to see if we hit day six. Size up 0.36%. Q's up 0.75%. Big day. Off highs. Big day. IWM up 0.37% as well. TLT is like one of the few things out there that's big picture that's red today. So interest rates up a little bit. You would think that that would be a negative for the stock market. The dollar up 0.5% today. It's a decent sized move for the ZUP ETF. That daily chart looks like it could potentially break out again. So also pretty big move there. Gold through the roof, 1.9%. $364 now for this GLD ETF. Really, really, really impressive. The Bitcoin's up 2.1% today. It's starting to really extend through all-time highs. Ethereum's up 4.3%. What a monster. Solana's up 1.2. Oil's up 1.7. So pretty much everything out there is green except for bonds. And all of like the things that we pay attention to, like the dollar and rates and all that stuff, you would think would actually have acted as a negative for the stock market today, but it's being offset by pretty much what happened with Japan, right? So Japan got like a super dove elected over there. I'm not an expert on Japanese markets. I'm not an expert on currencies. Definitely not an expert on Japanese politics. You know, just not my area of expertise. Obviously, I've got enough knowledge to know the impact of those things on the broader global economy, global markets, and obviously, particularly, what it means for the US. So, we have to think about obviously the actions that happen with the United States are the most important things that are going to have the largest impact on the United States. I think it's pretty obvious. But you also just have to remember that in this day and age, the world, everything is so global, all the economies are so global that it's not just paying attention to easing in the United States that matters. You have to pay attention to easing at a global scale. And we have been experiencing a large amount of easing on a global scale to begin with. And now Japan, which is one of the largest economies in the world, and for a long time has been a really close partner to the United States, is probably about to experience significantly more easing. So, what does that do? It bolstered the Japanese stock market higher, and it crushed the yen lower. So again, the dollar up, right? So dollar up, you might think, okay, bad for the stock market, and that is the right thought process, but it's being offset by this idea of just more stimulus coming in at the global scale, easing that's coming in at the global scale. And where you particularly see that is in gold, is in Bitcoin. That's why gold, that's why Bitcoin are up so much today, even with the dollar being up, especially compared to the yen. And if you listen to Paul Tudor Jones this morning, he was only on there for like 6 minutes, but there was a lot. There was a lot to grasp in that 6 minutes of what he was talking about. And he briefly made one comment where he was like, "It's more about the inflation than anything else." And this is what he's talking about. Like these are easing is inflationary, and these are inflationary trades. And that's the big, potential fear when you think about not just the impact of tariffs on inflation in the United States, but when you think about continued easing in the United States. It's one of the things that I was talking about maybe a few weeks ago as we were, going into our first rate cutting cycle here in the U.S. It's like, all right, it's concerning that you are doing rate cutting, which is inflationary, at the exact same time as you're doing tariffs, which is also inflationary, at a certain point they could feed on each other. But it's obviously a fairly populist move there. So we got pretty much all assets rising this morning, stemming from Japan. Yet at the same time, when I first woke up, I was like, man, I know that we're up because of this idea of like more global easing, global stimulus. But it seems like a big gap up to me when the Nasdaq and the S&P kind of closed weak on Friday, and we just had the VIX up for 5 days in a row, and the VIX is up again this morning, and the dollar is up big as well this morning. So I continue to not trust these moves. I didn't trust the gap up this morning. The fade of the opening gap up was a decent trade in the beginning of the day, but then the exact same thing happened today. The exact same playbook that seems to happen every day. You get the big gap up, they fade the gap up, but you can't break any support levels. You get to unch, it acts as gap fill support. You get to the equilibrium area, it acts as some general support. You get a pivot low that comes in, then a grind higher. I feel like we saw this on a couple different trading sessions last week where it was a similar situation. Gap up, sell down. We get excited because we're seeing some selling in the first 30 minutes, and then it just goes into an upside grind that pretty much lasts the rest of the day. And it's just the same thing. It's the same thing every day. The market can't break lower every single day. We're getting more general easing that's ongoing, right? That was the other thing that Paul Tudor Jones was talking about like this environment compared to like 1999, how in 1999 the Fed was cutting. In this environment, if you want to make the argument that we're in a bubble, which is an argument that I would make, we're actually easing into the bubble. So that can create even further explosiveness to the upside. Yet everybody in one form or another seems to say the same thing, and I'll say the same thing too, that we are in a bubble. So again, Paul Tudor Jones, I think, was perfect in his description of a lot of the times the last leg of the bubble is when the biggest returns to the upside actually come in. And if you're not involved in it, then you miss out on huge returns to the long side. But I think he described it as happy feet. You gotta have happy feet. You gotta be ready to switch. Because when that bubble pops, when the market pulls back, it can be violent and fast on the downside. And we know anecdotally, talking about violent and fast on the downside, if you could ever trigger any of this 100 percentile systematic selling or trigger any ETF, leverage ETF rebalance flows to the sell side because the market is actually going down, you could get something that feeds on each other, I think, very, very quickly. And that's why at the open today, I was so much paying attention to if this VIX could hold above 17. And I think I even joked when the VIX popped above 17 just after 10 a.m. and the market was only getting to its gap fill. I said it even before it happened because it's the same thing happens every day. We get this pullback, but we only pull back for the market to exactly where we should bounce, right? The spies pretty much pulled back pretty much to exactly where they should bounce, almost the gap fill area. The Qs pulled back to pretty much exactly where they should bounce, kind of their equilibrium zone. And at the same time, you're getting the VIX above 17, but I literally said it at 10 a.m. I was like, looks like this market is due for an actual oversold bounce here after selling down from the gap up, which probably means that the VIX comes right back below 17 and then we grind up for the rest of the day. And lo and behold, that is exactly what happened. It seems like this market cannot break any support levels. But I would just harken back to what I was trying to describe to Greta when I did my little podcast thing with her that was broadcast on YouTube about the downside on this market. And it's the same thing we've kind of been saying for a while. I know Billy Deek says it constantly here in the VTF at Sage Advice. You don't need to catch the absolute high to the penny if what we're talking about could actually occur, which is a feedback cycle of selling into the market. You can wait for a support level to break. You can shoot the retest of that support level when it holds as resistance to see if you can get continuation to the downside. And if that were ever to happen, you have the makings of a reversal pattern where then you're looking at a lower high leading to a lower low. And that is when you actually compress, especially if you're getting other confirmation factors, like you're hitting a vault control cell level because we're down 1% on the day. You're hitting the CTA trend following cell level, which I know is still 3.5% away at this point, so it's far off. Um, the ETF leverage cell is like 3% down as well. So uh, when it all comes together, when it all comes together, but you don't have to be a hero necessarily otherwise. So today's game plan I thought was perfect. Again, we said short the gap up, but don't be too greedy with it. Book your profit into the equilibrium area. And then once we've got our kind of confirmed high and we have a low that's been confirmed by equilibrium, then you know your important spots for the market intraday. It's the day high and the day low. And by more or less 10 o'clock, we had that. And it wasn't with the spies, at least, until 11:45 that we were breaking highs again, and everything was back on to full on bull territory. So yeah, I mean that just kind of continues to be where the market is. We had a couple other really good trades and really good call outs. I thought, you know, likening AMD to Oracle as something to look for the short off the open was solid. When that thing was moving down in the beginning of the day and it was still in the low 220s, I felt like you could press it, and I said as much in the VTF. So hope some people caught that. I found it a little bizarre that there was a couple people in the VTF that were talking about trying to buy this thing when it was in the upper two teens and low 220s. I really really don't like that trade. There's just way too much extension on every possible time frame on news that I think is a little bit hollow personally, and we have a repeat of the Oracle situation. So I really didn't understand that call out, and I was trying to tell guys like I think it's still a short. I think you can press the short side, and if you are trying to buy it, please make sure you got to stop it and manage the risk on that because I didn't get the trade at all. This is where you want to buy it. And I'm not just saying that in hindsight at 9:55 when it puts in the low, but that's when you want to buy it. Almost catching the ADMA would be better if it pulled back even a little bit more. You get the bigger volume that's coming in. You get a little bit of a tail hitting all at the same time. Then you buy this on the way up versus that low, and you hope that the ADMA catches up to the low, and that this thing can break some intraday resistance at 210, and then give you upside continuation, which it never really does, but it holds that low for most of the rest of the day. Like if you're looking for a long, that's the type of patience that you need to have into that large of a gap on this type of name. But that was a pretty good trade. I've been talking about, but without much excitement, a Microsoft long through 520. So got to give myself credit where credit's due, but I got to give myself credit where it's not due, or not give myself credit when it's not due, I guess is what I should be saying. For like 3 days in a row, I've been saying I think that Microsoft is a buy above 520, but I don't have strong conviction on it. And we mentioned it again in the morning meeting today. Microsoft through 520 through the inside and up, and if you did take it, it kind of turned into I think like possibly the best trade of the day. Busted through that 520 right in the beginning, good volume confirmation, good continuation on that trade also. And then beyond that, I feel like I'm continuing to do what I'm doing too much of, which is spending a lot of my day in wait and see mode. You get the technical pullback. I feel like I have a good strong advantage when we have a gap. Shorting the gap up this morning made sense. But once we get that pivot low that comes in, I'm not pressing downside. I'm not pressing downside until I can see real selling come in. What would real selling look like to me? We get the pivot low at 10 a.m. We bounce back here for 30 minutes, percentage retracement of the opening move, create a pivot high, almost like it looks like there's some upside tails here at 10:25, 10:30. Get a lower high, break that low, break yesterday's low, get the S&P negative, have us go green to red, and have it continue to look like they're selling on going after 11 a.m. And then all of a sudden, maybe I could press to the downside. But I just kind of go into wait and see mode after the open because I still feel very uncomfortable buying a market move up that I just feel like is not healthy. And I'm trying not to press downside because pressing downside has not been paying, and there was no signal to do so. So that's I think a good summary of today's price action and where we're at. I wonder how much we'll gap up tomorrow. That's my sarcastic comment of the day because we gap up little bit every day, a little bit every day, and then we satisfy the extension from the gap, and then we grind higher for the rest of the day. It's been this market's been like a broken record on the upside, and yet at the same time, we never get to extreme extension. Spies right now are less than $5 off the ADMA on the daily chart. There's no extension for the spies really to speak of. The Qs are $5 off the ADMA on the daily chart. There's no extension to speak of. I don't know what we need. Like part of me's nervous, and I think this is what Pat was talking about a little bit into the close. Pat was saying, market still looks bullish, and I agree with him. It at least partially looks like you actually need this market to really stretch up because for as strong as September and some of October have been, there really haven't been any cases of extreme upside extension in this market. Do we get there on the 22nd? Eyeballing it, it's the only time we look close. We basically didn't, and this is with the Qs. Spies probably aren't as good. We got like 20 cents away from extreme upside extension in the Qs one time in September, on September 22nd. There's been no extreme upside extension with this market to speak of. So I don't know. Do we need the VIX to plow through 17 on the upside while the market gets to $20 of upside extension in order for this market to go down? I certainly hope not, because it'll be painful in any shorts that I currently have open. So that's all I got. Happy to turn it over to you guys for any fun questions that you may have. Well, Scotty, what are your main leading indicators that we are flipping to bear market mode? Um, so I don't really use indicators. And I'm not 100% sure what you mean by the question because there's a few ways that I could potentially answer that. But if you're thinking about like traditional indicators, I don't look at any of them to be honest. RSI, MACD, stochastics, whatever. Um, and and also none of them would indicate, bear market mode. They would just indicate that maybe the market's stretched and needs to pull back. And honestly, I don't see anything that says we're switching to bear market mode. That's too big of a call. The things that I'm looking at, which we've gone over a bunch of times, I'm happy to dive into some of it. The things that I'm looking at are more indicating that we need to have a larger pullback in the market. And depending on the degree of that pullback, if you hit a certain point, it can become violent. So the main indicators, if you want to use that word that I look at, are basically flow of funds information, right? All the flow of funds information that we get in the VTF every morning, we get in the Pat's note every morning, and I can kind of list what I think the important ones are that are there, right? And it goes back to kind of the same stuff, like when can this market crash? When can this market pull back? Well, you need to have the conditions for a crash. But when you have the conditions for a crash, it still doesn't mean that you crash. It means that you have the conditions for a crash. It means you could crash. It means that if something were to happen, if something were to trigger, you could find the other selling that becomes a knockoff effect that creates a much bigger selling situation. And what I would say to you is that the flow of funds information, which is the number one thing that I look at as an indicator, if you will, says that there is heavy, heavy risk to the downside right now, and that they're all lined up, but you have to actually trigger it. And it seems like the problem is the more this market moves up, it's like the further away those triggers to some degree are becoming. It depends on which one you look at, but you know, some of the main ones I'm looking at are vol control systematics, CTA trend following systematics, um, synthetic gamma of leveraged ETFs, uh, the gamma profile itself of the market, um, all that, right? And then there's obviously bull flows as well, which honestly, the gamma profile of the market still is a bull flow. It's insulating on the way down. But, you know, if you could get Tate posted the information this morning. If you could get a 2% down move today, it would be met with $47 billion worth of additional selling. So if you need an intraday move, right? How much the market closes up or down in a given day is the realized volatility of that day. So today the SPY closed up 0.38%. So realized volatility for today is 0.38. If you could get a 2% down move, if you get I mean, I don't feel like scrolling up and finding the chart. You can scroll up and look at it. If you had a 0.5% down move, it's probably a few $1 billion of selling. You get a 1% down move, it's probably like $10 billion of selling. You get a 1.5% down move, it's probably like $25 billion worth of selling. If you get a 2% down move, it's like $48 billion worth of selling. That's one of them. That's not like that all the time, right? And I know you're newer on the team, so if you've only started in September, you've only seen it where vol control has risks to the downside, and if you had high realized volatility, it would create forced selling. But back in June and July and May, it was the opposite. We were looking at, oh my gosh, like vol control is set to buy 10 billion today, buying massive amounts, and they were doing that every single day on a reduction of realized volatility. The closer the S&P closes to zero, unchanged on the day, the more the systematic bid was on the way up, the whole way up. And that was a super bullish thing that we pay attention to that I don't want to fight. But at a certain point, when they're buying $10 billion every day, they slowly run out of stock to buy, and eventually realized volatility gets so low that any increase in realized volatility actually creates selling. So that would be like a really important piece of information, a really important indicator to understand. It doesn't mean that the market has to go down. It does not mean the market has to go down. What it means though is if the market can go down, then you are going to get significantly more selling that's going to be forced from the systematics, as opposed to in June and July. Remember, we were coming out of a bear market, a big bear market that ended in April. In May, June, and July, it was the opposite. It was as long as the market doesn't crash today, we're going to be getting significantly more buying. So in that period of time, the risk is greatly to the upside. The positioning risk is greatly to the upside. Now, and this is the biggest thing that I like to pay attention to, and it's been extremely consistent for us for years to study this information and know it. It's not a timing tool, but every single time positioning gets extreme, we're able to capture really big moves in the other direction. But it's not a timing tool. It still has to be triggered. That's the point that I keep trying to get across. And in this move higher now, because realized volatility at the index level stays so low, it's becoming one of the longest times that I can remember where systematic positioning is so long and the risk is so much to the downside without it actually triggering. But this is a market of records, right? We just got a new record from last week that we were able to share with everybody this morning, which it's the first time in the data set of the VIX going back to 1990 that you had the S&P up 5 days in a row and the VIX up 5 days in a row. I thought we were going to get day 6 today, and we ended up not. The VIX closed red. So that I think the most near term risk, if it could happen, would be an increase in realized volatility to the downside that forces additional selling. Because you could trigger that to begin to sell if the market could just go down 1% to 1.5% on a day, let alone 2%. Then that's the most near term flow of funds positioning risk. And then the question is, does that selling, if that were to occur, create enough additional selling to get us to the next triggers? The next trigger is basically the CTA trend following systematic trigger, which is sitting somewhere below 5,600 now in the SPX. I'm not exactly sure where. So it's like somewhere between 6,500 and probably like 66, 65, 80, maybe something like that. Um, but that's that 3.5% down number that we keep kind of quoting. And that's far away. But could you get a 2% down move intraday that causes enough selling to trigger that next trigger from an entirely different community of systematic selling that's 3.5% down? Maybe. And also, we had seen from a Nomura note at the end of September, the other flow fund dynamic is that, and Clifton Jones spoke about this today as well, this one, which is leveraged ETF, uh, the leveraged ETF fund flow, right? Which it's interesting to think about like the dynamics of now versus like 1999, and I was able to see data somewhere that showed that the market in some ways has more margin now than it did back in the 90s as a percentage of the market cap of the stock market. But the difference is like um if you're just on regular margin overnight to the long side, you're paying interest on that. But if you own a leverage ETF, you're kind of not paying interest on it, and that's, I think, enabling this market to actually be more levered long to the upside than it was in 1999. So in some ways, that means that you're able to create an even bigger leverage bubble now than you were really ever able to create in the past. And that works in both ways, right? Because leverage ETFs need to rebalance. So, if the S&P is up by 0.4% and there's a 3x leverage ETF that's supposed to be up 1.2%, there's a lot of assets underneath the surface there that that levered ETF is going to have to purchase in order to stay balanced, in order to have the 3x of assets basically compared to the single X S&P. So that's why Charlie McGallagher talks about that as a source of synthetic negative gamma, because when the market goes up, those levered ETFs need to buy even more. When the market goes down, they need to sell even more. And they were noting that it's just getting so extreme right now that if the market could pull back 3%, the leveraged ETF community would need to sell $90 billion worth of stock. So basically what I'm saying is, and I don't know how much the trend following community would need to trigger below the 6,500 area short term trigger that UVixable seems to have just given us. That's the Goldman one. The Bank of America one has a little bit higher than that. But I can tell you some of these numbers because they've been quantified to me in some of the research that I've read, which is if you get a down 2% day in one individual day, you met with $47 billion of extra selling. If you get a 3% down move in the market, it's $90 billion of additional selling. For reference, $50 billion is usually the amount that moves a market in a typical day. Okay. So whenever we want to be thinking about like flow of funds data, um, you want to be thinking about it off of like a baseline number of 50 billion. So if we're seeing like we were back in June, wow, there's set to be $10 billion worth of systematic buying today. That's a massive number within the context of a typical day of like $50 billion being kind of a baseline. Or when you see that, so the other statistic, which is a huge bull buy flow, is the buyback community. The buyback community, on average, is buying over $5 billion worth of stock a day. Remember, that's on average, because right now in October they're in their blackout window and they're not doing nearly as much buying. They're probably buying 2 billion. When then they go outside, like in the month of August, they're probably buying 8 billion a day. But again, think about that number in context again of the 50 billion number, right? Buying 5 billion a day is a lot when you're doing it on average. But now also think about these selling flows that would come in if they could ever trigger compared to that $50 billion average. If you could have a 2% down move, you're going to trigger $47 billion worth of selling. That's as much selling triggering from the vol control community off of one day as you typically see of the entire marketplace's worth of flow in one day. That's how big that number is. It's what makes that risk so much so to the downside. And then if you get the market down 3% and you've got $47 billion worth of selling that's coming from vol control, and you got $90 billion worth of selling that's coming from ETF levered rebalance flows. And the number I can't quantify, but I know it's a large number as well, is if you can get to that 6,500 or whatever, like that's 3.5% down to trigger the trend following community as well. That's an additional sell flow. And this is how the market works, right? The market works in cycles and feedback cycles of buying and selling where these things feed off of each other. But the question that we've been asking for a month, because we have been in the situation where the risk is to the downside for a month, is where or what can be the trigger? Because the biggest pullback that we have gotten since the absolute low of the market in April was a 1.3% pullback in the market. That was 2 weeks ago, from highs to lows. 1.3%. 1.3% over 3 days, over 2.5 days. You know what that triggers of all the flows that I just mentioned, of all the sell flows, what that actually triggers to force additional selling? It triggers nothing. It triggers absolutely nothing. We had 2.5% down days and like a 0.25% down day. None of that's enough of an increase in realized volatility to force selling from the vol control funds. None of that pulled 1.3% down move in the market was not enough to get you below the CTA trend following community systematic trigger. 1.3% of a down move was not enough to trigger the leveraged ETF rebalance to be enough selling to make it significant. It was nothing. It wasn't enough. And if you guys remember, it was just 2 weeks ago. It feels like forever ago, when this market was able to go down 0.5% intraday. We were like, "Oh my God, the sky is falling." because we're all memory-based human beings who forget what it looked like back in second half of February, March, and April, where the market was able to go down 2% every single day, or more. Right, 0.5% down felt like the sky was falling. You haven't seen the sky fall. Wait till some of these things can actually trigger. But again, we pay attention to these things because we know that they're there when they're there. They weren't there in June. So that risk wasn't there to the downside in June in the way it is now. But what we say over and over and over again, and this is the key to it, is that it has to trigger, right? That's the key. Otherwise, the trend is your friend. Because even though you can't trigger that greater sell flow, and even though there is probably less buy flow right now, there still is buy flow. You do still have the long short funds and the institutions who are not long enough, which they're scared of the fact that they're not long enough. So there's some degree of FOMO buying and chasing that's coming in from them. You do still have the corporate buyback bid, which right now it's in the blackout window, but the blackout window is probably, a couple $1 billion of buying a day, most likely. So you're still getting a couple $1 billion worth of buying that's coming from there. So and the gamma is probably the biggest one. The positive gamma in the market that comes from the option selling ETFs that have been created, the income ETFs that have been created. That's probably the biggest supportive flow of this entire market right now. And you have to be able to overwhelm that supportive buy flow in order to get this market to actually be able to trigger any of the spots that sell. So I forget what the latest number is, but I'm gonna assume it's like $7 billion of buying into a 1% down move. So most likely into a 1% down move, the gamma buying is equaling out any vol control. And not that we've had a 1% down move, by the way, but if you were to get a 1% down move, it's probably just like a break even flow at that point. The gamma buying offsetting a little bit of vol control selling that could come in at 1%. You need something that can actually break the market lower in an individual trading session, or over the course of several trading sessions, break them like an individual trading session where you could get like 1.5% to 2% down, or over the course of several trading sessions, something that can get us down 3%. And the whole thing that everybody's talking about is what could possibly be that trigger that creates the selling. It's not the government shutting down. It's not I don't know. It's certainly not the AI deal that we get every single day in the market that bolsters this market even further. Um, it's not an employment number because we don't get employment numbers anymore. They're right. We did have 2 days of downside, which still wasn't enough to really trigger anything. At the end of July and the very beginning of August, we had 2 down days off of an employment number. That was close. Like we're almost there. Like if we could have gotten like one more big sell day there, it could have been it. But it was too early in the cycle still. End of July, first day of August. Just there was still too much corporate buyback bid and other flows that were there to counter that. So you need it to all come together where you get some sort of trigger that causes the selling that creates the additional selling. And I have no idea what that trigger is, but what I do know is every single time that I've seen the market hit this point where we're at like 100%, you know, systematic ownership and systematic positioning risk is to the downside. I do know that it becomes very dangerous to own stock big picture. That I know unequivocally. We've seen it time and time and time again. And that's why I keep saying like I'm not predicting this necessarily, but I do want people to be aware. It's not impossible, and I'm not predicting. You mentioned bear market. Still answering your question, Scotty. You mentioned bear market. I'm not here to predict a bear market. I have no idea. All I'm saying is the risk is to the downside. What that could look like, just to give you one example, there's a few ways that it could look. What that could look like is a repeat of a similar situation of August 2024, where you were in the exact same situation from a positioning perspective, and you got a news trigger that came out of Japan that wasn't the end of the world, but it created a positioning shock because everybody was short the VIX, just like right now everybody's short the VIX. And the long positioning from the systematics, I remember, was very long at that time as well. And what you were able to get was a 3% down, sorry, a 3 day down move that brought you from 555 down to 510 in 3 days. And that's enough. That's enough to wash everything out, right? Um, so, you could get, again, not calling for this, but we know like the big pillars in this market are now sitting between like 6,500 and 66. If you somehow, I don't know how, but if somehow you get that 2% down move intraday that can overwhelm the positive gamma flow, um, that creates the forced selling, you could see a situation where you have, bam, down 2% day followed by a down 2.5% day. And all of a sudden, in two trading sessions, remember, we saw this almost every day back in February, March, and April. It sounds impossible. Doesn't it sound impossible to think about having a 2% down day followed by a 2.5% down day? We saw it happen time and time again earlier this year. But if you somehow got a 2% down day that triggers the vol control selling that overwhelms the buying, and then other people start to panic out of the market and they say, I told you that this market was too expensive and needed to go down. And you get a 2% down day followed by a 2.5% down day that triggers the ETF sell rebalance flow that triggers the CTAs to trigger. You could get a move to somewhere between that 6,500 to 66 very quickly. The break of that 6,500 could get you down to 6,350, 6,300 very quickly. And then that probably becomes the buy opportunity that you really want to buy after everything gets washed out. But we got to take that one step at a time. What I just explained right there, that is one example of how it could work. There's other ways in which it could work also, right? There's been some chatter that I thought was a possibility, but it hasn't been a possibility if the Mag 7 could weaken out because the indexes are market cap weighted, that you could get like a grind down in the indexes. I thought that that's what we were seeing a little bit 2 weeks ago, is a grind down in the indexes, and then maybe that grind down in the indexes triggers something that becomes a little bit bigger, and the grind down in the indexes is just forced because of weakness from Mag 7, and weakness from Mag 7 matters because of market cap weightings. Thought we were seeing that actually just a couple weeks ago, and then obviously we made the equal lows and then made new highs. So that's off the table, and yet that's even with most of Mag 7 still not trading well. So there's a couple ways in which down can happen, but you know, just to repeat myself, there's a couple key takeaways. I'll just try to sum it up and then I'll stop rambling and I'll move on. Risk to the downside does not mean downside, right? Risk to the downside means that there is risk to the downside if it can trigger. Um, but that doesn't mean that it has to happen. And the trend is your friend. And trends can last for a very, very long time. And there are flow of fund dynamics that are still bullish that are out there. But we need to be prepared right now that while you can still ride this trend long, and probably should be, and while you can still buy breakouts, and you probably should be, especially with these crazy meme stocks, um, that if it goes back to what Paul Tudor Jones said, you have to have happy feet. You have to have happy feet. Don't be afraid to ride the trend because the last leg of trends, the last leg of bull markets are where a lot of the biggest gains come from. But when things change, they could change very, very rapidly if they ever trigger because that risk is to the downside. So it's my final point there. Whew. From John M. I'm thinking of doing a little more scalping intraday or 5 minute opening range breakouts. Any suggestions in terms of these strategies? I'm holding swings less right now, just looking for opportunities. Yeah, I mean that's what I've been trying to communicate during the day for myself more. Also, distorting off the opening high, distorting off the pivot highs, the situations where we're taking advantage of smaller time frame extension for little snapbacks on a 5 minute chart. Those have been the trades that I've been looking for too. You have to be selective with them, and you can take them in either direction. But I do think you have to be selective with them. You really need to have the trigger there, and that's been where my head's been at. I can't get myself to put on these new bigger picture longs. I can't get myself to add short without any of the stuff that I've previously spoken about, a break of support, retest of support holds as resistance. So what does that leave me with? It leaves me with smaller day trading opportunities. The scalp off the high in the market at the open, off of AMD when it opened. And I didn't have any good examples from today, but on some of these other trading sessions, we've had some great, cute short ideas when the 5 minute gets extended and we get a shooting star, a short versus the high. So yeah, I like that. From Liam, when would you start to add that pullback if it was a non-catalyst based crash? It's like I said, an uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower highs and lower lows. Show me that there's a downtrend on even a small time frame. Show me a support level break that gets retested. Previous support can act as future resistance. Show me a support level that gets broken, that gets retested, holds as resistance. That is inherently a lower high. Show me that a lower high can be a lower low after that because the initial movement down breaks. And then I'm showing you a market where you can try to push downside. And then we'll see what we can get from it. We'll see if we get any triggers. From Dennis, RGTI, was I in the right to be greedy today on RGTI? I shorted size above 40. Um, when we got the V, I'm assuming you mean on the second 5 minute bar. I barely covered anything. My first bigger cover that would have mattered was another 50 cents lower. And then I wanted to see if it could break into 37.36, cover more 34.33. It looked like market correlation was there in the morning, but market also bounced. I stuck with my plan. But my plan was too greedy. Yeah. Problem was I held too much size and then move back up. Yeah, I mean, I agree with what you're saying. I don't hate what you're doing there. I think it was a little greedy. I would have suggested covering more if you had size. Like size versus that hard stop, I would suggest covering more. If you had less size because you were starting small because you're willing to build in, now that this RGTI is a day 3 after its bull flag breakout and it's getting obscenely extended, and you've got less size with a build-in approach, then I would say, yeah, don't cover very much of that because you don't have as much size. But if you were heavy, I would probably have looked to have covered more into that initial down move that you got. From Uvixi Bull, do you think the following levels that Morgan Stanley is putting out on their triggers could be realistic if reached at this point? Even the short term is almost 4% away. Like how do you even touch that with everything 0.5% down or more getting bought back up every time? Yeah, I think I can answer that. So the 64.98, that's the number that I had seen from Goldman, but like 2 weeks ago. So I don't know. I've never seen Morgan Stanley publish CTA sell triggers before. I've only seen Goldman do that. These look to me like the Goldman numbers, actually, all three of them, but they look to me like they're slightly dated. I thought that the latest Goldman update, we'll probably get a new one. They usually publish it on Monday night, Tuesday morning. But I thought that the latest one that I had seen was a little bit above 6,500. And then I saw the Bank of America one. I saw that over the weekend. I don't remember what it is off the top of my head, but I know it they give a range, and that range, I don't remember it. I don't like the Bank of America one as much, but it was like 6,500 to like 6,580, something like that. So a little bit more of a range. So I don't think it's as far down as what you're posting here with the 64.98. But I hope that we will get the Goldman Sachs update tonight, tomorrow, because this should also continue to move higher, right? With the market moving higher, even if the interesting thing would be if the market could ever move sideways, because if the market could ever move sideways, I think that the short-term struggle would continue to move up, and that would be a great way. That's why, circling back to that price action from 2 weeks ago when we actually went down a percent, 1.3% over 3 days. I thought that action was really, really interesting and potentially signaling something because you had equal lows, which was a challenged trend. You had a 1.3% down move, which isn't crazy, but if we could have continued to move sideways or be a little weak, a little bit grindy to the downside because Mag 7 was staying weak, then and CTA trigger would continue to move up. It would just become much easier to actually trigger that with more of like I cited an example from like 2024 as well, early 2024, where the market started as a roll down and the roll down accelerated. I thought maybe we could have been setting up for that 2 weeks ago, but then Nvidia broke out to new all-time highs. We got 25 new AI deals, and the market made new all-time highs also. So that kind of ended that. But that's what I'm looking for is something similar to 2 weeks ago that's slightly more sustained, or an actual forced sell event trigger, right? Which that's the hard part. What could possibly be the event? No one knows. Sometimes I feel like there's some gray swans out there. A gray swan is a big risk that everybody, kind of sees existing. I can't even really think of any gray swans right now. I can only think of a black swan, and I can't think of any black swans because inherently, if I could, it wouldn't be a black swan, would it? So yeah, hope that helps there, Mr. Uvixie Bull. Um, Hopping over to the YouTube, I'm seeing my buddy Mr. Trees is back. What's up? Are you thanking your lucky stars that you weren't short AMD like a bunch of the other weaker tech mega caps? I was seeing AMD up 37% this morning on that news, and I was so surprised that I wasn't short it. So yeah, thanking my lucky stars. It's a scary time to be short, right? Because the other thing that scares a lot of me about being short right now is the socialist government of ours that's starting to take stakes in all different types of companies. Who knows, man? You could just be short a stock, and the U.S. government decides that they want to take a stake in the company, and it goes up 80%. Um, that's some scary socialist risk to the upside for this market right now. From Plasma Labs, the stock market delivers a mix of good news and bad news. Commentators often select which stories to highlight based on the day's movements. Yeah, it's for sure from CNBC. To improve your trading, I recommend turning out CNBC and similar talking heads. In my view, it's a smart step forward. I haven't watched CNBC since COVID. I don't watch any of the talking heads. Josh sometimes subjects me to it when I have to go to the office. He turns it on. I don't watch any of that stuff. All I do is read research. That's all I do. I don't watch any news channels at all. Entirely just reading research, drawing conclusions, knowing what the bull case is and the bear case of any given time, and knowing where the balance of risk lays most for the different cohorts. That's what we want to do, and then define risk, reward, and probability of success off of that. Back to Dennis. Yeah, I usually cover more aggressively. I think didn't want to fill me slightly lower, and I think I overread the quality of the setup a bit. Yeah, I like to cover somewhat aggressively early on that percentage of my position so that if the trade fails, it's not a big deal. It's after that that I like to be really greedy. After I've gotten those first handful of early covers to make sure that, all right, I'm good, but look, there's a lot of bigger picture reward here. So now that I've gotten the covers that I need in order to get good, then I can push for the bigger downside. All right, gang, it is 5 o'clock. It looks like I got through everything on the YouTube and I got through everything on the virtual trading floor. So I'll hit you with the have a great night and I'll see you all tomorrow.